Hello students, how are you? All are fine. This is costs and management accounting 2, chapter 1, which is cost, volume, profit analysis. We will see in detail this concept is for these some periods of times. We will see together in detail now. As introductions, every managers of a company classify cost as fixed and variable when making decisions that affect the volume of output. The volume of output is affected by those costs, as you know, fixed and variable cost. You know the difference between fixed and variable cost. You should have to differentiate that. So uh, fixed is fixed whether the volume of activity is changed or not, and the variable is changed when the volume or activity is changed. So the managers want to know how such decisions will affect cost and revenues. So every management of the company must know the effect of those costs, okay, on revenue and the costs. They realize that many factors in addition to the volume of output will affect costs, yet a useful starting point in their decision process to specify the relationship between the volume of output and the costs and the revenue. So the starting point here is that we should have to identify or specify the relationship between volume of output and also cost and the revenues. Then we should have to know CVP, cost volume profit. Okay, cost volume profit analysis is one of the most powerful tools that help managers as they make decisions by facilitating it facilitates quick estimation of net income at different levels of activity. The most powerful tools that help managers they make decisions by facilitating. It makes quick estimations of net income at different level of activity. At different level of activity, quickly net income estimate የምናደርግበት አንዱ cost volume profit analysis ነው ማለት ነው። It helps managers also to understand the relationship between cost, volume, and the profit. That means shortly, CVP means it is a interrelationship between cost, volume, and the profit in an organization by focusing on interactions between the following 5 elements. We focusing on price of the product, volume or the level of activity, per unit variable cost of the product, total fixed cost of the product, and the mix of the product sold. So we will see those in details. So we will see we should have to know the interrelationship between cost, volume, and the profit of the organization, but we should have to focus on those 5 elements. Okay, we should have to focus on those 5 elements. You should have to know the price of the product, volume, level of activity, price per unit variable cost, total fixed cost, and the mix of the products. Then it examines also the behavior of 3 different factors. We should have to know the behavior of cost, volume, and profit. Okay. Furtherly, we should have to know in detail the relationship between them, the total revenues and the total cost, and operating income as change occur in the output level, selling price, variable cost, or fixed cost. So those decisions include, for example, what product to manufacture or sell, what pricing policy we should have to follow, what marketing strategy to employ, and what type of productive facilities to acquire. So we should have to decide those activities, those concepts. In this chapter, we will see we should have to differentiate. We should have to know the contribution margin and the gross margin. We should have to differentiate the difference between contribution margin and the gross margin. It seems like the same, but they are different. Prepare and interpret a contribution income statement. We should have to calculate break-even sales volume in total dollars and also in unit also. We should have to construct a cost volume profit graph. Okay, we will see the methods of CVP analysis also generally. Apply CVP analysis to determine the effect of the profit change in fixed expense, variable expense, selling price, and the sales volume. We should have to explain the role of cost structures and operating leverage in CVP analysis. We should have to identify the limiting assumptions that underlie cost volume analysis. We should have to explain the effect of sales mix on profits. So we should have to start from the basics of CVP analysis. On the start of the point, we seen that the CVP means the interrelationship between cost, volume, and the profits. Okay, by focusing on those 5 elements that we've seen before. So generally, the concept is so persuasive in managerial accounting that is touched in on virtually everything that the managers does because this wide range of usefulness. CVP analysis undoubtedly the best tool for a manager. Okay, the use or the importance of CVP analysis is unquestionable. Okay, it is very important for every manager of the organization who is discovering the untapped profit potential that may exist in an organization, because CVP analysis help managers to understand the interrelationship between those three elements. That means cost, volume, and the profit. It is vital tool in many business decisions. Okay, in every business decision, it is very important or crucial tools for every business enterprises. Okay, then when we see the difference between contribution margin versus gross margin, the form of income statement used in CVP analysis shown in below, we will see that the projected income statement of ABC Merchandising Company for the month ended January 31, 2016 as example. The income statement is called contribution margin approach to the income statement. The contribution income statement emphasizes the behavior of the cost, and therefore it is very extremely helpful to managers in judging the impact on profit to change in selling price, cost, or volume. Okay, so for this company, for example, this is merchandising company projected income statement for months into January 2016. For example, sales variable expense. The difference between total sales and variable expense is contribution margin. The difference between contribution margin and the fixed expense is net income. This approach is known as contribution approach to the income statement. Okay, this form is contribution approach to the income statement. Okay, ይሄኛው contribution approach ነው የምንለው ማለት ነው። The contribution margin represent the amount remaining from the sales revenue after variable expenses have been deducted. After we deduct variable expenses, okay, the left amount is known as contribution margin. Okay, the left amount from the total sales after we deduct variable cost is known as contribution margin. After that, after the contribution margin, when we deduct fixed expense, the left is net income. This approach is generally known as contribution approach to income statements. Thus, it is amount available to cover the fixed expense and then provide profit for the period. It covers the fixed expense. Okay. The sequence here, contribution margin is used first to cover the fixed expense, and then whatever remains goes toward profit. In ABC Merchandising Company income statement shown above, the company has a contribution margin of 40,000. Okay, contribution margin of 40,000 means the difference between 200,000 and 160,000. The left one is 40,000. This is contribution margin. Okay, this is contribution margin. In this case, the first 32,000 cover fixed expense, and the remaining 8,000 represents the profit. Okay, let our fixed expense 32,000. It covers fixed expense. Then the left amount from this is net income. Okay, or we say profit here, only 8,000 after we cover those expenses. Okay. Uh, Thus, it is the amount available to cover the fixed expense and then provide profit for the brain. The sequence here, contribution margin is used first to cover the fixed expense, contribution margin to cover the fixed expense, and then whatever remains goes towards the profit. In the ABC merchandise company, the income statement show above the company has contribution margin profit of 40. After that, we deduct fixed cost 32,000, the left amount is net income or profit. Okay. The per unit contribution margin indicates by how much the contribution margin is increased for each unit sold. For each unit sold, how much it increases. Okay. For each unit sold, how much it increases. It represent for how much unit for each unit. Okay. This, for example, here is 4. We have 4 contribution margin in each product. Okay. Then ABC merchandise company contribution margin of 4 per unit indicates that each unit sold, okay, each unit, 1 unit means, okay, it contributes 4 bill to cover fixed expense and providing for the profits. If the firm had sold 5,000 units, this would cover only 20,000 of their fixed expense. That means 5,000 times 4 per unit. Okay, 20,000. Okay, it only covers 20,000. Therefore, the firm would have a net loss of the 12,000 here. Contribution margin is, if for example, if contribution margin is only 20,000, our fixed cost is 32,000. Okay, the fixed cost is greater than that margin, so now it is a loss of 12,000 here. Okay, a loss of 20,000. If enough unit can be sold to generate 32,000 in contribution margin, then all of the fixed costs will be covered and the company will have money to show neither profit nor loss, but just cover all of its costs. If if we have only sold to generate only 32,000, okay, we cover only our what? Our fixed expense. Then we have loss or not? No, we have no loss, but we have no gain. Okay, no loss, no gain, neither loss nor gain. No. To reach this point called, it is known as break-even point now. Okay, when revenue and cost is equal means, okay, to reach this point called break-even point, the company will have to sell 8,000. Okay, for example, if you sell 8,000, 8,000 times 4, it is 32,000. Okay, 32,000 minus 32,000 is 0. So it is neither profit nor loss. This is break-even point. Okay, this is break-even point. That's very important point that you should have to understand. Here, for example, if the contribution margin is, okay, 32,000, our fixed expense is 32,000, the net income is 0. If you sold only 8,000, okay, 8,000 times 4, 32,000. Per unit, for example, if you per unit 20,000,